This is Ugland House. It's just an ordinary 5-story office building in the Cayman Islands. But by 2020, around 20,000 companies were registered at this single address. That leaves only two possibilities. Either it's the most crowded office building in human history, or something else is going on. Of course, the answer isn't office space. This is a mailbox address used for tax avoidance. Politician Bernie Sanders called it a tax scam, and former President Barack Obama also described it as the biggest tax scam in the world. For those who use it, though, it's just part of a complex and fully legal system known as offshore banking. It's a doorway that allows the ultra-wealthy to become almost invisible to tax authorities and regulators. What is offshore banking? At its core, offshore banking means placing your money, assets, or even a business entity in a country different from where you live. But it's not just any country. People don't move their money to Germany or Japan for offshore purposes. They go to special places, tax havens. To understand why these places exist, we need a basic economic principle. Every country needs money to survive. Some countries sell natural resources like oil. Others sell high-tech products like cars or electronics. And then there's a unique group of countries that don't sell physical goods at all. They sell something invisible but extremely valuable, their own legal system. Places like the Cayman Islands, Switzerland, British Virgin Islands, Singapore, and Luxembourg have taken this path. They design their laws to attract global capital. They offer extremely low tax rates, sometimes even zero, and they minimize cumbersome reporting requirements. As a result, money from all over the world flows in, without these countries needing to build a factory or mine a single resource. It's estimated that over $10 trillion is held in offshore centers, roughly 8–10% of the total financial assets of every household on the planet combined. Swiss banks alone hold more than $2.5 trillion. Why do the ultra-rich use offshore accounts? If you're ultra-wealthy, you're not focused on how much money did I make this year. Instead, you care about, after taxes and all the regulations, how much money do I actually keep? Offshore structures give them 3 key advantages to maximize their wealth. 1. Taxes, the most important factor. Tax havens either don't charge or charge extremely low rates on the most significant taxes. This doesn't mean total tax exemption, but it creates an environment where your wealth can grow without being eroded by taxes in the country where it's held. 2. Privacy. When you set up a company in an offshore center, your name as the owner often doesn't appear in any public records. This anonymity protects them from public scrutiny, competitors, and, of course, tax authorities. 3. Simplified reporting. In countries like the United States or those in the EU, every major financial transaction is closely monitored and can trigger red flags for investigation. Offshore centers typically have much lighter reporting requirements, making financial management easier and more discreet. How does offshore banking actually work? Step 1. You set up a shell company in a tax haven. On paper, it's a fully legal company with a registration number and an address. But in reality, it has no employees, no offices, and no active business operations. It exists for just one purpose. Step 2. This shell company becomes the official owner of all your assets: stocks, bonds, real estate in London, a yacht in Monaco, royalties from a song, venture capital investments, basically everything. At this point, you might think, but I own the company, so isn't it basically the same as owning the assets? That's where Step 3, the genius move, comes in. Step 3. The shell company itself isn't directly owned by you, it's owned by a trust, which is established in another country, like Jersey. Within this trust structure, you are not the owner, you're a beneficiary. And here's the key. Tax laws are written to target the owner of assets, not the beneficiary. Legally, you don't own the assets. Legally, you don't own the company that holds the assets. Yet, through the complex terms of the trust, you maintain full control over how the money is invested and used. To see the power of this kind of system when it's scaled to its largest, you don't have to look far. Just take Apple as a classic case study. In the early 2000s, Apple set up an extremely clever tax structure, often called the double Irish with a Dutch sandwich. It sounds complicated, but the basic idea is straightforward. Apple created subsidiaries in Ireland that held the intellectual property and sales rights for all Apple products outside the Americas. That means the massive profits from selling iPhones, iPads, and Macs across Europe, Asia, and Africa flowed into these Irish companies. Here's the loophole they exploited. Under Irish law at the time, a company was only taxed if it was managed and controlled in Ireland. Apple's Irish subsidiaries were officially registered there, but were managed from Apple's headquarters in the United States, so Ireland couldn't tax them. Meanwhile, under United States law, a company was only taxed if it was incorporated in the United States. These subsidiaries were incorporated in Ireland, so the United States couldn't tax them either. The result? Apple effectively created stateless companies for tax purposes. They didn't legally belong anywhere, and so they paid almost no tax. The numbers are staggering. Between 2003 and 2013, Apple routed over $120 billion in international profits through this structure. The effective tax rate on that income? 0.005%. That means for every $1 million in profit, they paid just $50 in taxes. Instead of paying roughly $40 billion at normal rates, Apple only paid a few hundred million. It wasn't until 2016, after years of investigation, that the European Union ordered Apple to pay back €14 billion in back taxes to Ireland. Even then, the case demonstrates the immense power of leveraging international tax laws at a global scale. Here, it's important to make a key distinction: the difference between tax avoidance and tax evasion. Tax evasion is illegal. It's when you deliberately hide income or falsify information to avoid paying taxes that the law requires. That's a crime. Tax avoidance, on the other hand, is completely legal. It's about using lawful strategies and exploiting loopholes in the system to minimize your tax liability. What Apple and the ultra-wealthy do falls into this category. They aren't breaking the law. They're hiring the world's best lawyers and financial experts to play the rules of the game to their maximum advantage. Offshore banking is the arena where this art of tax avoidance reaches its highest level. So here's the question: if none of the money or assets are technically in your name, how can you actually access it to enjoy life? If you simply move the money from your offshore company into your personal account in the United States, it instantly becomes income, and you'd have to pay taxes on it. The ultra-wealthy have an even smarter solution. Never turn assets into income. Instead, borrow against them. Here's how it works. You walk into a big bank and say, "I want to borrow $10 million. The bank asks if you have collateral. You show them your $100 million in assets sitting inside your offshore company in the Caymans. The bank is happy to lend you $10 million at an extremely low interest rate. That $10 million loan is not considered income, so it isn't taxed. Suddenly, you have $10 million in cash to spend, travel, and enjoy life without paying a single dollar in income taxes. The goal of this video isn't to show you how to do this yourself. For most of us, it's simply impossible and incredibly risky. The point is to lift the curtain and give you a glimpse of how the game really works at the highest level. If you found this video eye-opening, don't forget to hit like and subscribe so we can explore even more secrets of the financial world together.